The average UK house cost £29,000 in 1983. Today, it's around £285,000. Your parents didn't get lucky. The money itself changed. Here's the receipt nobody's reading. 4 decades of money supply expansion, quietly flowing into bricks and mortar. Why deposits feel impossible, why rent keeps climbing, and why the generation that bought in the 80s built wealth in their sleep without doing anything differently. Stay till the end. The third one changes how you think about all of this. Let's start with what actually happened. Nationwide Building Society has tracked average UK house prices since the 1950s. In 1983, the average property cost £29,000. By 1997, it was £62,000. By 2007, before the crash, it hit £183,000. And by the 2022 peak, it touched £271,000. Nearly 10 times the 1983 price in under 40 years. So what actually moved? Here's what didn't keep pace. Wages. ONS annual survey of hours and earnings shows median full-time pay was around £8,000 a year in 1983. By 2023, it was roughly £35,000. That's about a 4-fold increase. Houses went up nearly 10 times. Same period, same economy, completely different trajectory. The gap isn't explained by productivity or effort. Something else drove it. In 1983, the average house cost roughly 3.5 times average earnings. That was the old rule of thumb. Borrow 3 times your salary, buy a house. By 2023, ONS UK House Price Index data showed that ratio was over 8 times average earnings across England. The target didn't just move, it doubled. You didn't get worse at saving, and here's the thing that breaks most people's brains. Interest rates in 1989 hit 15%. That's Bank of England official rate history. So even though houses were cheaper back then, mortgages were brutal. Then rates started falling. They didn't stop until March 2020 when the Bank of England cut to 0.1%. Think about what that does to how much a buyer can afford to bid. But here's what most people get wrong. They think house prices went up because everyone suddenly wanted houses. That's not the full picture. The real story is about what happened to the money itself. When rates fall from 15% to near zero, the same monthly payment buys a much bigger mortgage. When a buyer can borrow more, they offer more. That's not demand for housing, that's demand inflated by cheap money. 3 forces drove this, and most people only ever talk about one.
And then came quantitative easing, QE. The Bank of England launched its asset purchase facility in March 2009, buying government bonds to inject money into the financial system. By November 2021, total BOE asset purchases reached £895 billion. Meanwhile, in the US, the Federal Reserve's balance sheet grew from roughly $900 billion before 2008 to nearly $9 trillion by early 2022, according to the Fed's own H.4.1 statistical release. This was not a small tweak to the system. Bank of England Working Paper 489 found that quantitative easing boosted wealth in top quintile households far more than the rest. They documented the side effect themselves. The institution that designed and ran the policy put it in writing. Here's the split he created. You own assets before 2009, you get a tailwind. Cheap money flows into the things you already own. House prices rise, your wealth inflates without you lifting a finger. You don't own assets in 2009, and you're trying to buy into a market being bid up by money created specifically to push prices higher. Same economy, 2 completely different experiences of it.
And this matters because of who actually owns what. According to the English Housing Survey 2022 to 2023, published by the Ministry of Housing, Communities and Local Government, about 65% of households in England are owner-occupiers. Around 19% rent privately. Around 16% are in social housing. So when QE pushed property values up sharply, over a third of households received none of that asset uplift. They just got higher rents. Here's the QE timeline most people have never seen laid out. March 2009, Bank of England launches QE with an initial £75 billion injection. 2012, extended to £375 billion total following the Eurozone crisis. 2016, an extra £60 billion after the Brexit referendum. 2020, COVID hits and the bank injects £450 billion in a single year. 3 separate waves over 11 years, each one sending more money into a system where housing is the primary store of wealth for most UK families. So the mechanism runs like this. Central banks cut rates and create new money. Borrowing gets cheap, so buyers can offer more. That bids up prices. Existing owners see their wealth rise and can borrow against it to buy more. Institutional investors, also using cheap money, pile in alongside them. More demand, same constrained supply of houses, prices keep rising. This isn't a housing crisis caused by planning permission. It's a monetary policy side effect that ran for 40 years. The people who won weren't smarter, they were earlier. Buying before the money supply expanded dramatically was the only variable that really mattered. Not location, not timing the market, just being in the market before the printing started. So what does the mechanism actually tell us? Point 1. The relationship between wages and house prices broke because the supply of money expanded dramatically while housing supply stayed constrained. ONS UK House Price Index data from 2024 shows the affordability ratio in London is now over 12 times median earnings. In the Northeast, it is closer to 5 times. Same country, same monetary policy, completely different entry points depending on where you are standing. Point 2. Inflation doesn't just eat savings, it transfers wealth between people who own things and people who don't. When prices rise, the person holding the asset sees their balance sheet improve. The person paying rent sees their rent rise to match it. The Resolution Foundation's 2023 intergenerational audit found that households born in the 1980s are significantly less likely to own a home by age 35 than those born in the 1960s. The mechanism doesn't care about effort, it cares about timing.
Point 3, and this is the one that changes how you see everything else. The system wasn't broken by accident. Cheap money was a deliberate policy response to a financial crisis. It worked in the sense that it prevented a depression, but it also meant the 2010s and the early 2020s were a period where owning assets was systematically rewarded by policy, not by productivity. That's not a conspiracy. That's just what central banks do when the economy needs stabilizing. The question is always who was positioned to capture the gain when they did it. Back to that $29,000 house in 1983. Your parents didn't buy smart, they just bought before 4 decades of deliberate money supply expansion flowed into the housing market. People who already owned assets got rich, and now the receipt is being handed to a generation that wasn't at the table when the money was printed. That's not bad luck, that's how the mechanism works. Bank of England Working Paper 489 found QE boosted wealth in top quintile households far more than the rest. The institution that ran the policy documented the side effect in their own published research. If you found this useful, the video on how interest rates actually move house prices goes deeper on the mechanism. Subscribe if you want the stuff the mainstream doesn't explain properly.